Hi, Steve here at Promise Money, and today I'm going to be talking to you about regulated homeowner bridging loans. Okay, so this is where you want to raise short-term finance secured against your home. If it's regulated, then it can make a massive difference to the choice of lenders that you get and the whole process. So it's important you understand this, because it might not be regulated, in which case you can actually escape quite a lot of hassle. But if it is regulated, you need to know the hassle that you're in for. So what do I mean by regulated? If you are securing a loan, first charge or second charge, for your own personal use against your home, it's virtually certain that that's going to be a regulated loan. Okay. It's possible that if the property is a buy-to-let property, but you've inherited it from a relative, let's say somebody's died, left you a house, you don't know what to do with it, we'll let it out, and you're thinking that's an investment property, because you've inherited it, or because family live in there or have lived in there, you can be classed as an accidental landlord. So they're regulated. Now, what does this mean, regulated? It means that the FCA are overseeing everything that happens with the lending in that sector. It means that lenders are worried to death about making a mistake and getting into trouble with the FCA. And it means there's a whole load of rules which apply to your scenario, which wouldn't apply if it was non-regulated. So let's just talk about the typical scenarios before we get into these rules that you've got to worry about. So typical scenarios could be, you've bought a house, you own a house, you've seen another one you want to buy, and this is called a chain break. And you can't buy that house because you haven't sold this house. But you've got an option to potentially take a bridging loan using the equity in both houses, the one you're buying and the one you're selling, to take a bridging loan which allows you to buy the second house before you've sold this one. Okay, so that's a chain break bridge. Another scenario could be you've done a load of work on your house. You suddenly realise, oh, I need some more cash. By which point you've ripped out the kitchen, you've ripped out the bathroom. You go to your mortgage lender and they say, I'm sorry, your house isn't mortgageable anymore. We can't lend you any more money. What are you going to do? I might need a small bridging loan to get that work done. That could be regulated. And another scenario we see a lot of is back garden builders. You've got a house with a nice big plot and a back garden. You think, you know what, I can get planning consent to build a house there. I'm going to build a house on the back, and then I'll split the title, sell it off. Happy days, I've made a load of profit. If that is within the title of your property and you're looking to build that, that's a regulated development. The rules apply. So let's talk about what the impact of it being regulated is. Well, the first big impact is, I couldn't tell you how many non-regulated bridging lenders there are out there, because people just, you could set up a bridging lender yourself tomorrow and just get on with it virtually because you're non-regulated. So the choice of non-regulated is massive. It's out here. It's probably off the side of the screen. I don't know. As soon as it's regulated, these are lenders that are authorised by the FCA. They have a strict code of conduct. They do things properly because they have to. They're frightened to death that they're going to make a mistake. So the FCA comes up down on them like a ton of bricks. So they cross every T, they dot every I, and they do everything properly. But there's probably not much more than a dozen or so lenders who do that. So your choice has gone from that to that. Okay, that's the first thing. That can impact on the rate you pay. In some cases it doesn't, if it's straightforward bridging, but if it's more down the development route, very few lenders want to do that. So you can end up paying more. On the plus side, the fact that they're regulated means that you're going to have more protection, that they're going to do things correctly, that they're not going to take advantage of you, they're going to treat you fairly. So those are good things. But the downside is, as a regulated lender, they have to protect themselves from being censored by the FCA. They have to do things rightly. They have to jump through lots of hoops. So they're going to make you jump through those hoops. That's the downside. So here's the first thing. A non-regulated bridging loan, there are loads of lenders doing 18 months, 2 years. Some are even going longer, 3 years. If you take out a regulated bridging loan, not a non-regulated, a regulated bridging loan, the maximum term the lender can allow that to run is 12 months, okay? So if you're thinking of doing a back garden build, for example, you say, well, it'll take me, I don't know, 12 12, 13 months, 14 months to do this, to build it. Then we've got to sell it. I'd like an 18, 20 more, 24 month term, something like that. The lender's going to say, and the regulator's going to say, and I'm going to say, because it's the rules, sorry, the maximum term you can have is 12 months. So that means you've got to have borrowed the money, do what you intend to do with it, and exited that loan within 12 months. Now, if you can't do that, of course, these are regulated lenders. They're going to have some forbearance. They're going to be sensible. They're not going to come and repossess your house straight away. But they have to evidence at the outset that you could evidence to them that you're going to exit within 12 months. So that can be a problem. That's something that we would need to talk about and make sure that that works. Now let's talk about the exit. Non-regulated lenders again are a little bit more relaxed, but there's a lot. And by the way, non-regulated lenders doesn't mean bad. There's plenty of really good non-regulated lenders out there, but there are some who are interested in lending and not worried about the consequences of whether you can pay back or not. They'll just repossess your home. But there's plenty of decent lenders out there. But with a regulated loan, they're going to look at the exit really, really hard. And they will want to evidence that that exit is going to work beyond all reasonable doubt. Not only is it an exit that's going to work, it's an exit that in some cases could work now, you just haven't got time. And a classic example of that is people come to us and they say, look, I need to take out a bridging loan now because my business has only been trading 18 months. In 6 months' time, I'll have 2 years' accounts and I'll be able to exit. A bridging lender is going to say, a regulated bridging lender is going to say, no, you need to be able to evidence the exit based on the facts now. Another scenario, I've got some adverse credit. In 6 months' time, it's going to drop off the record and then I'll be able to get a mortgage at that point. No, you have to be able to evidence that you can get your exit based on the circumstances now. Okay. Now that might not be the exit you want, so we get into a scenario saying, well, you might, in 6 months' time, you might be able to get these lenders, but we've got to evidence an exit now before that change in circumstances happens. So the exit will be based on these lenders. That might not be the lender that you want to go with ultimately, but we've got to evidence that you've got an exit. So the exit is absolutely crucial, more so with regulated bridging. Another factor is that it will need to be an advised sale. So unregulated, you don't need an advisor. You might get one, but you don't need an advisor. Somebody could say, well, you can have that one, which do you want? Get on with it. It might not be a good idea. Whereas an advised sale, somebody's going to sit down with you and say, right, okay, well, I need to understand fully what you're looking to achieve, both short-term, long-term. I need to explain to you the implications of that. And if I think it's a bad idea, I'm going to tell you it's a bad idea. So that can slow the process down, but it gives you more protection. So it's not all bad. Having an advisor is a good thing, but it's an extra hurdle that you've got to go through. And all the way through the process, the lenders are going to do more due diligence because they've got to make sure they're ticking the regulatory boxes. Okay. So I suppose once you understand those restrictions, you understand the scenarios of what you're going to be using this type of bridging loan for, and you understand whether your loan is going to be regulated or not, is then, well, what do you do next? And I would say the most important thing to do is to make sure that you're dealing with a broker who's got access to all of the regulated bridging lenders, but also uses them on a regular basis. A lot of mortgage brokers they'll do mortgages all day long, but when it comes to bridging, they go, it's a bit specialist, that is for me. I don't really understand it. They'll probably come to people like us and say, right, I've got a client who needs this product, and can you go to the market and find out what's what? I think the key thing to do is to deal with a mortgage broker who understands bridging, but also understands mortgages as well, because they've got to be able to look at both sides of the coin. And they've got to have direct access to those lenders, and they've got to have either the expertise themselves or the people around them who can explain the pros and cons of different products, because it's not just about the rate, it's about the process, it's about the lender, it's about how long it's going to take. Let's say you bought a property at auction, you say, I've seen this house, I'm going to buy it, I'm going to live in it, I've got 29 days to complete, or 28 days to complete it, then your priorities change all of a sudden. Rather than it's necessarily the cheapest rate, because you've already paid your 10% deposit, it's, this has got to happen in 28 days. So we're then down to speed, we're down to lenders who can cut corners, find shortcuts. So yes, finding a broker who can advise you on both mortgages and bridging and has that expertise in-house. Really, really important. Be aware that there are brokers out there who are not authorised mortgage brokers, or, what's the best way of saying this, are selective on when they feel they need to be offering authorised advice and could put you in touch with an unauthorised or unregulated lender. Beware that. You understand whether your loan is regulated, understand the type of product you need. And the reason I say that is, and this is a today example, we've had a customer come back to us and said, look, I contacted you some time ago, and at the time you said you couldn't help for reasons A, B, C and D. So I went and got a bridging loan. Bear in mind, this is on their home. I went and got a bridging loan, and now I'm being repossessed because I can't repay it. That's because whoever looked at it possibly wasn't properly authorised, or I don't know. Anyway, they didn't look at the exit properly, and that person's now facing repossession. They've come back to us. Thankfully, their circumstances have changed, so we might be able to do something about it. But that's what you want to avoid. So be absolutely 100% sure of your exit, because the lender's going to want you to be sure. Your broker's going to want you to be sure, and you want to be sure, because the last thing you want is a short term, bear in mind it's only 12 months, 12 months bridging loan, and you're at month 10 or 11 and the lender's saying, okay, how's the exit going, what's going on, and all of a sudden the pressure's starting to come on. And if you can't exit that loan at that point, then the lender's got a difficult situation, and your best case scenario is they're going to say, well, you need to renew the facility, we're going to charge the fees all over again. Or we're going to charge you a default rate because you've gone into default. Now, all of these things will be in the paperwork that you sign, so you will be aware of the default rate and extra charges if you run over the term. But really, don't run over the term. Be sure about your exit, have it all worked out. So I think finally I'll just say, this is just one aspect of bridging loans, and I'm not explaining to you in this video how bridging loans actually work. I've done a load of videos on that, so do go to our YouTube channel, and the videos about how development finance works, how standard bridging works, refurbishment bridging. There's all sorts of products in there, videos in there, so go and check those out. And finally, I hope you found this useful. I hope you've not found it too frightening, because it isn't frightening as long as you do it properly. Please subscribe to our channel, please like our channel, please share it with your friends, and come back and see what we've got to say on the next subject. Thanks for now, and talk to you later. Bye bye.